In this learning objective, we're going to compute the direct labor rate and efficiency variances and explain their significance. Recall earlier, when we prepared a performance report, we compared our actual results, say for direct labor in this case of $87,000, with our flexible budget amount of $90,000. And we had a $3,000 spending variance, a $3,000 favorable spending variance. In this particular learning objective, we're going to try to break down that $3,000 favorable variance into two components and identify what was the source of that $3,000 favorable variance. The two components of that variance will be a rate variance and an efficiency variance. The rate variance will arise from the difference between the actual labor rate we paid during the period and the standard rate, which again is just the amount we expected to pay during the period. And our efficiency variance will be the difference between the actual labor hours worked during the period and the standard labor hours allowed, or the amount we would have expected to work in a given period. So in terms of our format, we will take the actual cost incurred, and we're going to put that in our far left-hand column, and our far right-hand column will be our flexible budget amount. Referring back to our performance budget report, we would have had the $87,000 in the far left-hand column, and our flexible budget amount, which we are now going to call a standard cost, will be on the far right-hand side. Let's look a little further at it. So the actual hours will be the actual amount of direct labor hours we actually used during the period. How many hours did our employees work? Our standard hours is the amount of hours we would have expected them to work to complete the number of units that we produced in the given period. The actual rate is the rate we actually paid our employees during the period, while the standard rate is how much we expected to pay them on an hourly basis in the given period. Let's go ahead now and look at an example where we compare our actual cost with our flexible budget amount. Sky Chefs Inc. prepares in-flight meals for a number of major airlines. During the most recent week, the company prepared 4,000 of these meals using 960 direct labor hours. The company paid these direct labor workers a total of $9,600 or $10 per hour. Notice, even if we weren't given the $10 per hour, we could calculate this by taking our total labor cost of $9,600 and dividing it by the 960 actual hours. According to the standard cost card for this meal, it should require 0.25 direct labor hours to prepare one meal at a cost of $9.75 per hour. Calculate our total direct labor variance and break it down into rate and efficiency variances. Let's begin by calculating our standard hours allowed to prepare our 4,000 meals. So we would take our 4,000 meals and multiply it by 0.25 hours per meal, and it should have taken us 1,000 hours to prepare these meals. So our total standard cost, or our flexible budget amount, would have been $9,750. That's the 1,000 hours times our standard rate of $9.75 per hour. We can see our standard cost is greater than our actual cost. So our total variance in this case is $150, and it would be a favorable variance because our actual cost was less than our standard cost. Let's go ahead now and break our total variance down into two components, a rate variance and efficiency variance. Let's begin by completing our center column. Our actual hours worked was given as 960, and that's the same thing we had under our actual column. We pick up our standard rate of $9.75, and we multiply the two together to get $9,360. In terms of our rate variance then, our rate variance is $240. That's the difference between the $9,600 actual cost and our center column of $9,360. And despite the fact that we would get a negative number, again, recall we always list variances as positive amounts. This variance would be an unfavorable variance since the actual rate we paid our workers of $10 per hour was greater than the $9.75 standard rate. From an efficiency perspective, our efficiency variance is $390, and it would be a favorable variance since our actual hours that we worked, it only took us 960 hours to prepare the 4,000 meals, while at standard we would have expected it to take 4,000 hours or 1,000 hours. So we have a favorable efficiency variance. And again, we can see if we combine our $240 unfavorable variance for our rate and our $390 favorable efficiency variance, we do indeed come up with our total variance of $150, which was favorable. Let's go ahead now and talk about how we would interpret our unfavorable rate variance and favorable efficiency variance in this case. Usually our production managers are held accountable for labor variances, and labor variances can occur because we have a different mix of skill levels assigned for the work, level of employee motivation, quality of product supervision, or quality of training that we provide our employees. Quite often, the production manager will claim that he or she is not responsible for unfavorable efficiency variances, in other words, if their workers took too long to complete a project, because perhaps they were unskilled workers, or perhaps the purchasing department purchased poor quality raw materials, which resulted in a lot of scrap and rework. In our particular case, notice our actual hours was less than our standard hours, so our employees worked more efficiently than expected. This could have been because by offering a higher labor rate, $10 was what we actually paid our employees versus our budgeted or standard amount of $9.75, we were able to attract more skilled and efficient or more motivated workers.